So we have actually the largest panel that we have over the next 2 days before us right now. Everyone on this panel is representing a Catholic organization that either is already investing in impact investing initiatives or is actively exploring doing so in the future. So I'm just with some quick introductions. I'm Glenn Kramer. I'm a Senior Managing Director at Providence Equity. We are a private equity firm. In addition, I've been involved with CRS for many years, was the treasurer for 6 years of the board, ending in September of last year, and continue to be active with the CRS Foundation, as well as our impact investing activities. So to my immediate right is Father Seamus Finn. Father Seamus is Director of the Missionary Oblates of Mary Immaculate, U.S. Justice, Peace, and Integrity of Creation Office from its inception in 1999 until 2015. He is also the Chief of Faith Consistent Investing for the Oblate International Pastoral Investment Trust. He is a leader internationally in faith consistent investing and has been, you may have seen him on or heard him on Bloomberg or CNN or CNBC, et cetera, CBS, PBS. He's well known in this field, and so we look forward to hearing from Father Seamus. Next to his right is Father Tom McLean. Father Tom is the General Treasurer of the Society of Jesus, the Jesuits. Prior to this role, which he assumed in July of 2010, he was the president of Regis High School in New York City, probably one of the most famous high schools, Catholic high schools in the entire country. He was also pastor of St. Mary's Parish, student parish in Ann Arbor, Michigan, and treasurer of the Detroit province of the Jesuits. And he is in contact with many Jesuit entities around the world that are looking to grow their economic resources for the benefit of others. To his right is Dale Hunt. Dale is the Managing Director of Private Equity for Ascension Investment Management. Ascension, for those of you who don't know it, is one of the largest investors, Catholic investors in the United States. Dale is responsible for all of the private equity portfolios of Ascension, which includes manager selection, portfolio management. She's heavily involved in the impact investing initiative for Ascension. CRS is, in fact, an investor with Dale and with Ascension in Ascension's impact investing initiatives. Prior to that, Dale was CIO of the West Virginia University Foundation, and then prior to that had a very long history of activity on Wall Street. She's been involved in the investment business since 1978 and has had 20 years of experience in private investing. And then last but not least, Jean-Baptiste de François, we're honored to have as the president of the Institute for the Works of Religion, also known as the Vatican Bank. We are honored to have him here. He took over that role as president of the Vatican Bank in July 2014. Previously, he had a number of very prominent roles in Europe in the investing arena. He was chief executive officer of Invesco Europe. He was president of the European Fund and Asset Management Association. He was asked by Pope Francis to join the Vatican Council for the Economy in March of 2014, and then shortly thereafter resigned to be nominated to become president of the Vatican Bank, which is a position he continues to hold. So with that, you could see we have a very esteemed panel this morning. And what I'd like to do is start us off with Father Seamus to talk about what he's been doing.
So thanks, Glenn, and good to be here, everyone. I'm glad to know lots of familiar faces from the first Impact Investing Conference, and glad to meet some new folks at the table. In many ways, given our number of presentations this morning, our task is, I think, much more practical and much more basic in the sense that we're looking for investing Catholic funds and how different Catholic funds are approaching that. So the way I'm going to do that is very simply to take a look at what we do with the OIP Investment Trust Fund. Just provide a very quick context for you, just so for those of you who may not be familiar with this. This was a fund that was created by the General Council of our congregation in 1991, primarily because a number of our units across the world didn't have the adequate capacity in terms of how to invest funds besides buying investments in local banks, or besides looking for putting it in regional credit unions, looking for a much more sustainable, somewhat more aggressive, but at the same time risk-averse way of managing their funds. The congregation stimulated that fund by putting $20 million into it. Today it's $407 million in it. And it's seen by the congregation as a service for the smaller units of the congregation. What does that mean? There are about 135 participants in the fund. They come from 60 different countries, from as small as the Vicariate in Quetta in Pakistan, to many of the Bishops' Conference funds from Sri Lanka. So there is very much a connection with the history of the congregation, and where an oblate may have gone on to be the bishop of the diocese or the like. That was very much the determining factor. It's now, about 3 or 4 years ago, has been opened up to other Roman Catholic entities. So previous to this, it was only oblate or oblate-related entities that invested in the fund. The investment vision basically has a global mandate. The assets are invested and deployed in about 80 different countries, if you were to take a geographic attempt to look at where they are. And a fairly aggressive diversification in terms of asset class. So that basically means that, to get to more focused what we're talking about this morning, more recently, about 12 years ago, the managers of the fund and the chief investment officer started to look seriously at private equity. And now have gone into that to the extent that there's about $87 million of the fund is in private equity funds, right? So I'll come back to that in a second. And then the last piece up here, one of the commitments of the fund is that 1% of the fund would be invested in impact funds of various kinds at a concessional rate of return, okay? We'll spend just a moment on that as we go forward here. So, in terms of our understanding, our definition of impact investing as we've gone through this, because look at it this way, we have about 16 screens that exclude what we won't invest in, all the way from nuclear arms to tobacco to adult entertainment to abortion to climate. Those things are all exclusions that we've had over the years. So the question that's always kind of hung out in the air is, that tells you what you're not going to invest in, do you really want to invest in? Which is what gets us to the impact investing question. Looking for market rate of return, willing to accept, in some instances, a higher risk profile. I think one of the questions which will come up is, obviously, a number of the folks in this space are new funds, and our investment committee isn't always comfortable with a first fund that somebody's starting, or folks who haven't had previous funds. There are younger teams quite often in this space, and sometimes riskier markets. But that's basically gives you a sense of what we're talking about. We're beginning to have more, I think, come together with more definition and clarity for the members of the committee and for the participants in terms of how we see or understand impact investing. The current impact investments as we see them, and I'll go into one of these so you can see it in a sec, 8 Miles Fund, Sofinnova HealthQuest, those are the amounts that we have in those funds next to them. Neuberger Berman Real Estate, which was a fund we went into because we liked what they were doing in terms of trying to keep families in their houses in the United States who were threatened by foreclosure in the post-crisis period. Elevar, I'll mention a little bit more, HealthQuest, Pembani, Remcra. So that is about $50 million of the fund is in where we consider the impact investing space. Let's focus on Elevar for 1 second. Elevar is, any folks in the room familiar with Elevar? I'm sure you are, so you know what we're talking about. Every community, in terms of their vision and person, has intrinsic economic and social value. The entire investment focus is to capitalize entrepreneurs who create global systems access for disconnected communities. That's kind of their vision statement that you'll see. They're at the moment in 24 companies in 7 countries: India, Peru, Mexico, and the Philippines. That's important from our perspective because when looking at some of these funds, we like to look at funds that may have an overlap with where we do have actually oblates or oblate colleagues on the ground. So when you look at India, Peru, Mexico, and the Philippines, we have a presence in each of those countries. So that will sometimes, is one of the criteria that's going to come up for discussion. If you want more details on Elevar, it's elevarequity.com. So Pembani Remgro is an impact infrastructure fund in Africa. This is just at the beginning, but we've made a commitment of $10 million to it. Again, they're looking at the infrastructure issues around rail and rail cars and cargo and the like, but also into some other areas. But let's look at 8 Miles because I think that's probably the more interesting. Sub-Sahara, we have a $10 million commitment invested in 2012. The total in the fund is $190 million. And they've called so far $122 million. That's the basic footprint. There are 7 limited partners. The other limited partners that we're joined there with are the Africa Development Bank, the IFC, which is the private equity piece of the World Bank, Invesco, the Commonwealth Development Fund, and the like. So what do they do? This is their look at the tier 1 countries that they were interested when they presented in investing in. And you can see those, so I don't need to go through them. Then they had a set of tier 2 countries, so that gave us a total of 18. The criteria, the key selection criteria over here that they were looking at, and across the top, agribusiness, business finance, consumer goods, healthcare, hospitality, and the like over there, all right? More specifically yet, where has that found us in their specific project investments? This is the more recent one. This is a bank in Uganda. I think where the fund is now 49% invested in this bank. This was just recent. Not a big bank, but one that was taken over by a Nigerian bank that then went into bankruptcy and was left on its own. So this is pretty much the kind of deal. Ownership, 8 Miles started out with a 42% stake. They obviously liked the growth potential and the rationale for acquisition. We liked it also because they were linking up with Centenary Bank. Do we have anybody from Uganda in the room? Centenary Bank is a bank of the Ugandan Bishops' Conference. We like to link up there because they have a huge branch system that they think they're able to take advantage of. Go quickly. It's another acquisition, Verde Beef. This is in Ethiopia. Verde Beef tells you about the number of employees, 6,000 head of beef. It's primarily an export piece. This has begun to scale up, and they've been invested, 8 Miles has been invested there for just about 2 years now. And the last one, couldn't go away without talking about Awash Wineries, because I know we have some Ethiopians in the room. As you know, Awash Winery had a monopoly on the wine in Ethiopia, and things have begun to change slowly. This has been a tough slog for the fund, but in terms of employee, some of the things they're doing on a regular basis, they have an ESG metric that's included in their report back to us of jobs, training, housing that they're putting up for the employees and the vineyard and the like. A lot more available on the website in this, but just wanted to give you a snapshot of 3. 8 Miles is at the moment invested in 6 different and looking at different projects and looking at 2 at the moment in Nigeria. The other most recent one was a poultry investment in Uganda. Last section I mentioned the concessional side here. Just thought I'd give you a sense of this. Up to 1% of the assets, I already mentioned that, so that's now at 4 million. Socially beneficial goal, fund is happy with receiving less than market rate return. The current ones that we're involved in is Sapphire Fund, Microvest. I think lots of you in the room would be familiar with Microvest. Global Partnerships out of Seattle, and the Lift Fund, which is in the southwestern part of the United States. A quick look at, oops, we went away. Quick look at Global Partnership. So our arrangement there is very simple. We have a $0.5 million loan with 4 different tranches, okay, that depending on the maturation of the loan, the interest rate varies from 1% to 5%. So the first tranche is at 1%, next year the second, and the third, and the fourth. What do they do? Improving economic position and quality of life. Since inception, they'll tell you how much capital they've deployed. They're looking here in terms of invest in manufacturing and distribution that provide households living beyond the grid with access to solar lights and small solar home systems. It's one of the things they do. Second one is building economic resilience. Again, to empower women living in poverty by investing in microfinance institutions. A lot more detail on the slide, and I think these slides will be made available to you afterwards. Improving health and economic position. Again, aims to improve the health of women living in poverty by investing in microfinance institutions. So that's another microfinance focus. This one is rural-centered finance and education. Invest in financial institutions that deliver tailored credit and education to the underserved rural households, which remain largely reliant on agriculture and livestock activities. And the last one, smallholder farmer services. Again, invest in agricultural businesses that provide improved market access and technical assistance to smallholder farmers. So again, is a general overview. I think in what I've said is the focus is very much through the private equity space on the market rate of return and somewhat different instruments through which we have put some money into less than market rate return projects through an intermediary like Microvest, like Global Partnerships and the rest. Thanks much.
Thank you, Father. We'll have an opportunity for questions at the end. I'd love now to turn to Father Tom to talk about what the Jesuits are doing.
Thank you. I don't know about you, but I hate it when people start their talks by telling them who I am after I've already been introduced. But I want to do that because my history tells you how I've become a fussy customer of impact investing. Seamus and I both have funds that are pretty similar in size, but I'm a different type of customer. You know, I started out 25 years ago as a treasurer of a province, and in that time it was negative screening was what we did. And we've all been through that struggle of trying to decide which negative screen keeps everybody happy. No one is ever happy, and nothing is ever pure, but we struggled with that. But that was a time when I think most, if not all, entities held individually managed accounts, separate equities and bonds and the like. I moved on to Regis High School. Situation changed a little bit. The industry changed a little bit more. We were looking more at investing in funds and actively managed funds and less in separately managed accounts. There, the negative screening became a little bit more difficult. How can you find a fund that doesn't have something that you don't want or might not want in the future? And that became a much more difficult approach. And then finally, I've come to this point where I'm now the general treasurer with a fund close to about the same amount of money that Seamus was talking about. It's now global. It's now not just located in the United States, representing interests of people from around the world. And suddenly arrives on the scene impact investing, a positive screen. Certainly in the context of Pope Francis and the way he is approaching the world, or asks the church to approach the world, it's a much more positive approach. And so together, I think with that spirit in mind, the positive screen, looking for those things that will make a positive effect on for the part of the poor or for the environment is a way to go. And as a result, we have committed 10% of our portfolio to impact investing. Now, I'm a fussy customer because I find myself extremely worried. Once Madison Avenue gets hold of the concept of impact investing, managers will come and say, oh, this has impact. This has impact. And I think it's very important for us as religious consumers, we who I don't have the resources nor the time or the expertise to personally investigate various ventures on behalf of the poor, on behalf of the environment. And I find myself having to rely on the advice of a consultant who has the team, the background, to vet various funds and businesses that do vet the funds to make sure that there's a consistent investment philosophy, that there's a discipline in adhering to the philosophy, and that there is a decent record of management and performance over time. I need to rely on that, but I also would say in working with the consulting industry, this is something new for them as well. I don't find them as having as easy access to the whole world of impact investing. And I find them kind of saying, well, there's the ERG, there's ERG, and I consider that, and if I want to give you another new category, that's passive impact investing. And I'm looking for active impact investing, things that are putting money for work for the poor or for the environment, not those that are employing good practices so they don't do bad things. That's a strategy that I think the church needs to insist on if people are going to begin to approach us realizing that we have resources to make available for impact investing. Unfortunately, there is just an awful history, as I've been with different experiences of religious communities that have been kind of co-opted by glib-talking managers, and people will say, Father, I'll take good care of your money. Oh, sister, this is really good. Look at the pictures I'm showing you. And then they think they're doing wonderful things, but they're not, and they're paying high fees. That's my worry as we go forward into what I think is an exciting way of looking at investments in the world, that we protect well our desire to do exactly what we set out to do and not be co-opted by believing that we're doing something where really we're being, avoiding things being proactive. A little bit about what we've done. So our goal is 10%, but we just don't rush into it. We need to find things that are appropriate for that. To date, we are about 8% of our investments are in impact investing funds. The first we went to, then we've been with for about 3.5 years, is called Impacts with an X, Global Investing, which seeks to invest in various areas improving in the environment, air, water, energy, and the like. And over the 3 years, we've seen an 11% average return over the last 3 years, a little bit below the benchmark that we've set for it of about 12.2, so a little under the benchmark, but still performing well. We've recently added the NICO World Bank Green Fund, which is a fixed income fund. We've only been with them for about a year, and we're looking at a 3-year kind of horizon before evaluating them. They've been a little bit under a little bit below the benchmark. And then we finally just added Generation, the fund initially started by Al Gore with a sensitivity towards the environment, but I see that as a blend. I mean, they taught their ERG, ESG values, and then the other for the environment. So I don't count them as a full impact investing. That's where I get fussy as the customer. The last thing I just want to say is one of the other challenges that I have is as I sit on various boards of Catholic institutions, I find it very difficult to convince boards to put into their investment policies something for social responsible that has teeth. I find very often that, well, no, Father, we have a statement that we will do something that is socially responsible for the church, and that we'll make sure that we don't do anything that's not against it. But there are no metrics. I'm not sure that we're doing anything. So when I start calling for metrics, there is that pushback. Well, no, our primary duty is to make you money. Yeah, but we have to do so in the sense of the mission of a Catholic institution. Well, Father, we're going to make money and then we can give more scholarships to the poor. Yeah. But I still think, especially for educational institutions, we model to our students how we use our money. And so I think, from my point of view, to model that we tithe 10% of what we have for the sake of the poor, and perhaps realizing that we might not receive as much as we want back, but the poor do receive, and then in the end, the church, the poor, do win. So those are some overall kind of objectives that we've had in our approach. I'm grateful for impact investing. But as I said, I worry that we can protect this as an instrument tool for the poor and not be co-opted.
Thank you, Father. If we now turn to Dale Hunt.
There you go.
Good morning, and thank you very much for having us here. It's an honor. I just want to give you a little bit of a history of Ascension, because I think it's important as you think about how we approach impact investing. So Ascension was formed actually in 1999 when the Daughters of Charity Health System and the Sisters of St. Joseph Health System decided to merge and basically create a company. And then they were ultimately joined by the Sisters of St. Joseph of Carondelet. So Ascension itself has a short history, but obviously those orders have very long histories in the healthcare space. And if you fast forward today, as Glenn mentioned, we're the largest not-for-profit healthcare system, Catholic healthcare system in the United States. We have 142 hospitals and 30 facilities for the aged, for senior citizens. And the reason that that's important is that as we entered into the impact space, and we really started to seriously think about this 3 or 4 years ago, our definition, and people do sometimes have different definitions of impact investing, ours is very much aligned with our Catholic heritage and with Ascension's stated mission, which is to serve all persons with special attention to the poor and vulnerable. So impact investing, as I mentioned to Father Tom earlier, is really part of our DNA. At Ascension, if you talk to our CEO, even though I'm in the investment management subsidiary, I think of myself as a caregiver, and that very much permeates everything we do, so I think that's important. So, as I said, those are our impact objectives. You can see that what I just stated is aligned with Ascension's mission. Our goal is really to make investments that we will believe that will be beneficial both from a social perspective or an environmental perspective, but which do deliver what we call a market-based return. And we are firm believers that we can generate the types of returns that we can get from our traditional investments from our impact investments. Our strategy is to focus on private funds, so we don't buy public equities yet. We do have screens. All of Ascension's portfolios, even traditional portfolios, have socially responsible guidelines. So we have separate accounts for all of our equities, fixed income, where it's basically the negative screen, where we won't invest in certain sectors. But in terms of here, what we're looking to do here is invest in private funds that, and you'll see on the left, there's some of the social areas that we're focused on, things like food and nutrition, affordable housing, healthcare, education, and then on the environmental side, conservation, water, and those areas. So those are the areas where we're focused, and we do this by investing private equity, private real assets, and private credit. So we are long-term investors. We invest in long-term funds, and as the prior panel talked about, we consider ourselves patient capital. So we started our impact program in 2014. We raised $50 million from 6 Catholic organizations. We've invested 43 of the $50 million to date in 5 funds, and we're working on we think will be our 6th and final investment, which will actually be a direct investment into a healthcare company in East Africa. And we're in the midst of doing due diligence on that now, and we hope to close that investment by the end of September. So our initial $50 million will have been invested then over a 2-year time frame, and then hopefully we'll move on to the next one. The other thing I should tell you is that each one of the 6 institutions in our fund, we meet with them quarterly. They have input in advance of any investment we do, so we review each of our investments ahead of time with our advisory committee so that they can really opine on whether they think it's meeting their definition of impact. Really, again, to Father Tom's point. So this is a list of the 5 funds that we've done so far. You can see that it covers the spectrum of food production, ag, housing, renewable energy, financial services, and then the final one, which will be a healthcare investment. And I'll just briefly go through each of those. So the first fund is an emerging markets food production fund. So we realize that food safety, food security is a global priority, particularly in developing countries. So our goal was to see if we could find a way to invest in the production and delivery of food into these markets that would be nutritious, safe, quality, high quality. So we found a fund, we invested with a fund that makes private equity investments across the food and agricultural chain in emerging markets. They focus primarily on protein production, so that would be dairy, poultry, beef, pork, aquaculture. They also look at the value chain food processing sector. And then lastly, at cold chain logistics and warehousing, which, as I'm sure most of you know, is important in countries like India, where there's a lot of waste, food spoilage, and the like of that. So that's what that last bullet point would address. So far, this fund has made 3 investments into portfolio companies. The example I put up here is they've started, as we call it a greenfield investment. So they've started a new company. It's going to be a dairy company. They're building 5 farms in Inner Mongolia to produce high-quality, safe milk. So that's the goal. Just to give you a little bit of background, we knew this group before we did our impact fund, and they did an exact same investment in their prior fund. So we were able to see how they demonstrated both financial returns as well as the metrics. Some of the things we'll be measuring is the improved milk yields. So how many kilograms of milk per cow per day is being generated? So in China, for example, the amount of milk that a cow produces is less than half of what it would produce in the US or Canada. And so what we're looking to do is get that yield up from 16 kilograms a day to 32, 34 kilograms a day. The other thing we'll be doing is measuring animal nutrition or animal disease. We want to reduce animal disease because that obviously affects the amount of production as well as the quality of the milk. The other thing that we're going to be focused on is sustainability. So how much of the solid waste is actually being converted into compost? And lastly, these farms each have biodigesters on it. So basically what they're doing is they're converting into energy this waste. And so we'll be measuring how much of the farms themselves are self-sufficient from an energy perspective by using some of this conversion. So that's the first fund we went into. The next one is a technology-focused fund. And not a lot of attention has been spent, not a lot of dollars or capital has been spent really on technology in the food and ag space, but yet we know that there's a huge demand for innovation. And by introducing technology, we think that we can really improve the food chain. So what we did is we wanted to find a manager that would develop technological solutions to things like crop production, water, food, nutrition, and the like of that. And we identified a fund in Chicago that does that. And so they today have already about 10 or 12 investments. These are very, very small investments in newly formed companies. So largely unproven in many respects. The one company I put up there is a San Francisco-based company that's developing a crop enhancement product using less water, basically. It's a water efficiency tool. They call it more crop per drop is what they're trying to achieve, per drop of water. And so the first instance, again, this is an early stage, newly formed company. So our first metric is actually product sales. Can they commercialize this product? Will the farmers buy it? So that'll be our first metric. And then we'll measure, has there really been improved crop yields, but using less water? And that'll be the next step. So again, this is a very early stage fund. This one, of all of the funds that we invested in, will probably take the longest to mature. The next fund we invested in was a low middle income housing fund in Latin America. And as you know, particularly in the urban areas of Latin America, there's a real shortage of acceptable housing in these areas. So we wanted to invest and develop a housing stock that we felt was safe, affordable, and also that has all the necessary infrastructure to provide clean water, electricity. And then the second point we make there is about communities. We also wanted to develop communities that would have green spaces, that would be safe and have some kind of security, that would have playgrounds for the children, access to transportation so the people could get to work, churches and the like of that. So this fund has already started to invest. The example I put up there is one development that they are building in Trujillo, Peru. It's largely for agricultural workers. They're building 2,500 units that'll be sold at an average price of $8,500 a unit. And so there we'll be measuring the number of units sold, the average price, eventually the, hopefully the average wage of the people that are living there. And so this is the first real estate related investment that we made. And then an African renewable energy strategy. So as most of you know, the lack of energy in Africa is a problem, lack of power. There are blackouts and shortages every day. So we decided we wanted to find a way that we could invest along somebody that was coming up with alternative renewable energy sources. So this is actually not a fund. We are investing alongside a company that develops these projects. The IFC is also involved in it as well. And we are building some renewable energy projects in Africa. The first one is a partnership that's going to develop 1,200 megawatts of wind and solar power, and it's principally in South Africa, Ghana, and Egypt. And then there will be subsequent projects after this that we'll invest in. So obviously we're going to measure the amount of energy that this is coming out, and then the price that that energy is sold at. And then the fifth fund, the last commitment we made was to a financial services related fund. Consumers, and particularly small and medium-sized businesses in many of these countries don't have access to true formal financial services, or if they do have access, they don't know necessarily how to access that. So we wanted to find a way that we could invest in the financial services sector in emerging markets. But we wanted to do it a little bit more on a more targeted basis. So we looked at a lot, as the panel said earlier, financial services, I think, is the #1 recipient of a lot of impact dollars. So there are a lot of financial services funds in the market. But we were trying to find one that was a little bit more targeted in terms of really identifying certain areas where they would be lending or providing credit. And we invested in a fund based in Chicago. And in fact, Patrick Fisher, the founder of the firm, is here. It's Creation Investments. And I'll give you an example. One of their companies is the leading motorcycle and tractor and solar power lender in Thailand, Cambodia, Laos, and Indonesia. And in these countries, by providing things like vehicle finance, equipment finance, household finance, those are the things that can help people really generate income and improve their lifestyle. So it's very, very targeted. But providing someone with transportation is a differentiator in their lives. So this is the first investment that we made in the financial services sector. Obviously, we'll be measuring the number of clients, the average loan size, the quality of the loan book, and how does that loan book grow year to year. And then, so this matrix just shows you, if you go back to the first page, you'll see we had the 2 lists of the areas we wanted to target. We think we've ticked most of those boxes with the exception of education. We did not find a education fund for us to invest in this fund, but we had told our investors that with this initial pool of capital, we would build a diversified portfolio, and so hopefully we've attempted to do so. Thank you.
And now, Jean-Baptiste, please.
Thank you, Glenn. Ladies and gentlemen, good morning. I'm very pleased and honored as well to be here. Although I'm going to be departing a little bit from what we have heard, I mean the 3 fascinating presentations and all the various activities that are taking place. I essentially would like to share with you one idea, but before I do this, I would probably need to tell you a little bit more about l'Istituto per l'Opera di Religione, which is usually known as the Vatican Bank. So allow me just for a few minutes to talk to you about what we do, and then share the idea which I believe will help us maybe broaden a little bit the conversation on the back again of those very interesting initiatives that we've just heard. So the Institute is a very small investment, is a very small bank. We have essentially 2 roles that we play for the Vatican. We are small, but we are important for the Holy See. We essentially play 2 roles. One of transfer payment. We allow all the economic activity that takes place within the Holy See to operate. We effectively bring in and out of the sovereign state of the Holy See the cash that is required to make the economy function. That's our historic activity, and that's one of the most important ones that we have. And second, we manage some of the congregations or dioceses' wealth, essentially European congregations and European dioceses, but also more and more from all around the world. And there we effectively offer a wealth service. And the comment that I'm going to make effectively refer more to the second activity that we have than the first one. But before I proceed with sharing with you my idea, I'd like to tell you that the Institute has gone through a very important restructuring program over the last 2 to 3 years. And what we have now is a very solid organization that respects all the various and most important rules that concerns banking activities in the world. We have recently released our 2015 annual report, and one of the one of the points that we really insisted on is, again, how compliant we are now with all international rules when it comes notably to those transfer activity that we have. So it's important to keep this in our mind. And we've effectively focused a lot of time and energy on these first activities, transfer of payments on behalf of the Holy See. And we are now looking at improving also the wealth management services that we render. And it's in the context of these activities that I wanted to share with you the following idea. Now, that idea is more a personal idea than it is a position that the Institute has taken. Clearly, the Institute is thinking forward as to how much we could have an impact when we manage assets, either for our own purpose or on behalf of our clients. But the Institute has not yet come up to a final solution as to what the way forward will be. The Institute has never invested in the non-listed sector. We've never been present in the private equity sector. We've always invested the 6 billion that we have on our balance sheet in listed securities. When I took over the chairmanship of the bank about 2 years ago, one of the first things we did, given the financial and economic circumstances at the time, was to fundamentally reduce the equity portion of our investment. So today we are essentially invested in sovereign fixed income, and that means that the very few initiatives that we had taken in terms of trying to become more socially responsible in equity investing have really came to a halt because we are not today, we hardly have any, probably not more than just a couple of percentage points invested in equities. But as I said, the board is very much trying to agree on what could be a position for the institute going forward. So we are predominantly a fixed income invested house today, and we are looking forward to, probably not in the too near distant future, when we will have to invest again in equities, given the current yield markets and the current economic circumstances. So what is the idea? The idea is, particularly when I look at such an important and prestigious gathering as today, but also when we talk to various Catholic institutions around the world, again, with a focus on listed securities, what sort of impact could we have if at least all Catholic institutions that invest in listed securities across the world had a minimum of a common denominator as to what they do or what they don't do? I think hoping that everybody would follow exactly the same rules in terms of socially Catholic responsible investment criteria is probably very, very difficult to achieve. But if we could have an approach whereby all major institutions of the Catholic faith who invest in listed securities take at least a common denominator, meaning at least 20 or 30% of every major investment decision that they take are shared or common. I think the impact we could have on the listed financial markets, on the listed security, would be tremendous. I mean, when you look at all the money coming from Catholic institutions that is invested in the securities market today, you're probably looking at hundreds of billions of euros, if not potentially thousands of billions of euros. And if we could at least share a minimum of common values when it comes to protecting the human life, protecting the human dignity, reducing arms production, pursuing economic justice, protecting the environment, and encouraging corporate responsibility, if all those institutions shared a minimum of values along the lines of what I've just said, when they invest in the stock market, the impact that we could have on listed companies, on those organizations that are looking to financial markets to finance their growth, I think we would certainly have a tremendous impact when it comes to investing Catholic fund for impact. Not directly responding to today's question, which is achieving impact for the poor, but certainly investing Catholic fund with impact on the financial markets. And ultimately, I think this joins the ultimate aim that this conference is looking at. Thank you.
Thank you. Thank you very much. Let me thank you to everyone. So let me just ask you all if you could respond to a particular question. We've been hearing all about the challenges and the benefits of impact investing this morning at the various panels. I'm curious if you think that there are certain opportunities or challenges that present themselves in a particular way for Catholic investors. If any of you have any thoughts on that particular question. Anything particularly for Catholic investors that's different than a non-Catholic investor, if there is anything?
Well, I have to believe that, you know, our history of social justice and the whole approach that the Church has directs our attention in a certain area. And that's where we're looking, and that's where I want to argue for a much more strict definition of what we are about. I don't want to be co-opted by guilt, you know. I want to do this because I want to do good for somebody in the context of the tradition of the social teachings of the Church. And let that be the guiding light in terms of what it is that we're looking to do and how we want to improve the situations for the poor, not for those who want to make themselves rich off the poor.
I would say that I think the challenge that certainly we face, and I think all Catholic investors face, is how you take the principles of Catholic social teaching and bringing them down, you know, at least one or two levels into a way that then is practical and measurable about and that you have some way of tagging that you are responding to those. I think we all do that. We do it. We look at Catholic social teaching principles. That's where we start. But then we're kind of pushed by those who do research to apply those screens to say, well, precisely what do you mean by that? So I think that's unique. And I think because Catholic social teaching comes out of the philosophical tradition as well as the biblical and the Catholic tradition, it offers that in general to the investing world. So I think that's, for me, is what is most unique about it.
Dale?
I just think from a practitioner standpoint, sanctity of life, preservation of life is critical. And so just from us, and we're a hospital organization, as an example, as a practical example, it's very difficult for us sometimes to invest in hospitals in certain markets if those hospitals do certain procedures. We just won't invest in them. And so we have to be really, really careful about that. It limits what we do in life sciences when it comes to embryonic stem cell research. We stay away from that. So there are just certain things that, in practice, it actually hasn't been, there are so many opportunities out there that we don't need to do those things, but I think there has to be certain awareness of that. So it's just something that is top of mind for us all the time.
So it's not either or, it's socially responsible investing with negative screens versus impact investing. You really appropriately look at both, so you need to have the screening in place so you're not investing in things that are against life or other screens that you would not invest in even for your non-impact funds.
That's right. I mean, we have things in black and white that we don't do. And then, especially in the private equity space, we'll see something come to us, may look like a very interesting opportunity. It's actually not in our prohibited guidelines, so to speak, but it just is tainted by whatever area it might be touching. Media comes to mind. Sometimes when you get into media, there are certain things that we just don't want our name connected with. And so it's really, for us, as I said, it's always front of mind.
And I'm curious whether you use, Dale, whether you use side letters, or any of the panelists, whether you use side letters to basically say, in addition, we're going to make an investment in a private equity fund that claims to be an impact fund, and that we are not 100% sure that they won't breach one of our guidelines, so we have a side letter that says you won't, or if you do, then we can opt out, and that sort of thing. Curious if you could respond to that.
We use side letters in all our private equity
Yeah.
placements.
In all of yours, yeah.
Yeah, we have side letters as well, and the way it operates is, when a fund is making a new investment, they issue you a capital call, and it's typically 10 days ahead of them actually needing the money. And so we have a side letter that says we get every capital call, they have to tell us what it's for, and then it's our responsibility to respond and say, no, yes, we can make it, or no, we have to opt out or be excused.
Great. Okay, let's switch for a minute. I'm curious, since all of you are investors, how you think about the trade-off between maximizing return on the one hand and serving the poor and providing social impact on the other. How big a deal is that trade-off? How challenging is that for you?
I certainly think it's still a very difficult conversation with a lot of investment committees, because I think the investment committees and the professionals and the consultants have been captive to a certain model of investing that makes it very hard to bring in the social question or the environmental question. I think data and research and the academic research has helped us to move beyond that in a way that I think it's now demonstrated in so many research places that one doesn't have to sacrifice return because you exclude certain sectors from your investment or certain industries. So on the other side of it, our biggest challenge, I think, is, if I understand Pope Francis correctly, I think he's asking for a capitalism 2.0. And so how do you create the corporations and the institutions that will occupy that space, banks and asset managers and consultants, that will indeed bring new perspective to those kinds of questions, that is not still fighting the old battle about, well, you're sacrificing return because you've put these screens in place. So I think it's both, and I think we've moved a long way in terms of don't often hear it anymore that you're giving up on return because of your screens, but it still comes up every now and then.
So, Father, I think you've merged two different concepts. One is, do you sacrifice return by putting in sort of screens, so effectively negative screens? And I think I think there's been research to show that over the long term you aren't. But the second piece really is this question: when you're investing for impact, is there a trade-off between market returns and social impact? So I'd ask our other panelists if they see a discrete trade-off there.
Well, I'm not sure I want to address explicitly the trade-off. What I struggle is, what's the appropriate benchmark? I'm right now in a conversation as we're looking at, I mentioned earlier, this NICO World Bank Green Fund, a bond fund, and the consultant says, well, I'm talking with them to find the appropriate benchmark. Well, who chooses the benchmark, I'd like to choose, the benchmark that's going to show me the best return. But I think that's where that conversation between the tradition of the professional investment industry in terms of benchmarks and return, and us in terms of saying, all right, what is an appropriate way to benchmarks impact funds? Should there be a universe of impact funds that they have to compete against? Or should they be in the global equity fund index or the blend that you find because of what they're at? I think that's the critical question. And then hold the managers to that criteria of the index that you're holding. That's part of diversification, too.
Yeah. Dale or Jean-Baptiste, any thoughts on this question? No.
No, not directly. Again, because of lack of experience
Sure.
as to what we're doing, today at EOR. But more generally speaking, on some of the questions you've asked, again, we are so much dominated. All the day-to-day life of so many people in the world today is so much dominated by the financial markets and the impact of financial markets. There are so many groups that are trying to influence those financial markets in different ways, not always in tune with our Catholic faith. The momentum that we could get and the ultimate result that we could get by really trying to gather force and have more impact on the way companies are managed, on the way decisions are managed, and ultimately on the performance that we will be getting. Because the better a company is managed, ultimately, the better the performance you should get, I think is really what we, in addition to those sorts of initiatives that we've seen today, what we should focus on.
Thank you. So for those three of you who are active in investing, you mentioned you have 1% of your portfolio, Father Seamus, that is concessionary return oriented. So implicitly, the other 99% is market returns that you're seeking. Father Tom and Dale, I assume you're 100% market return oriented.
100%.
Yeah, so that you're 100%. And Father Tom, do you have concessionary return strategies?
We put that all in the context of the benchmark that we apply to the various elements of the fund. It's just that the Impacts Global Equity Fund is with the rest of our global equity, and we look at it in that context, and it's got to hold its own in that area.
Right. So Pat Deneen, I'm going to call out to Pat. Is there an effort at this point to create a benchmark that is impact investing in private equity as opposed to just benchmarking all of these activities with traditional private equity?
Cambridge Associates and the JIC have published the first quarterly benchmark for impact investing. And
If you can't hear Pat, the answer is yes, as of about a quarter ago.
it's published. It's available on the web. And the early results, do I need a mic? You're going to see what the camera. Okay. Thanks. Yes, the answer is there is a benchmark for impact investing funds. It's based on only 51 or 53 funds now, but it's the beginning of an answer to Father Tom's question about what's the relevant universe. And we've got a long way to go because that 53 subset is not totally represented, but it's an attempt to quantify it. Now, as we pointed out in our panel, that's only the financial. It does not include the outcomes. So in order for it to be relevant, we are going to have to come up with some way. But it's a start, and the early results are very, very positive that, in fact, you don't have to make that trade-off.
That's great. That's great to hear. Thank you.
But on
Yeah.
that, I always worry about, are we dumbing down?
Yeah.
Giving them
Yeah.
the excuse, we'll put you with it's kind of like the reverse discrimination, in terms of academic criteria. And so that's a concern that I would have as we set up their own little kind of,
I know you're concerned about, and so is Cambridge Associates, and they compare it to a cohort of the traditional
Yeah.
index funds.
okay,
as well.
that's the control.
That's the control, and that makes sense. I agree with you. So let me ask you a question. So the very poor, serving the very poor, can they, in your opinion, can they be served through market mechanisms like impact investing initiatives, or is that principally the domain of philanthropy? How do you think about that?
I think any approach to any project that somebody is working on these days, I think the approach in terms of the financial side has to be blended. Mm-hmm. That it's appropriate where donations are the only avenue whereby you're going to respond to people who are hungry or homeless, but donations or a loan or an equity position or an impact bond or a variety of different. So I think the options are out there for the person who has assets about how they're going to deploy them, whether it's going to be charity, a donation, a grant, the list that's out there. I think that's a great thing. So it's like going to the supermarket and you have 9 different types of cola you can pick from, right?
Right.
So I think that puts it back on the person who owns the asset to say, how am I going to be most comfortable, feeling most consistent with what I believe, with how I deploy these funds? And I think that's a good thing.
Anyone else have a thought on that? Serving the very poor and whether impact investing has as much of a role as philanthropy in that particular subset?
No, I think you said it well.
Yeah. Okay.
I don't think they're kind of mutually exclusive. I think
Right.
there's a role for both. I mean, I always think of the example of, I know someone who, spent years of his own personal wealth in the area of malaria, fighting malaria in Africa, but it's things like, providing nets, simple things like that. That's philanthropy. But then there's investing in the company itself that's going to come up with the cure. And I think it's almost like a succession of events.
Right. So we only have a few minutes left. I'd love to open it up to the audience if anyone has any questions for this esteemed panel. I see one in the back here.
Hi, my name is Laure Vesemius. I'm the head of investments for Cordate, the Dutch Caritas. And what we've been actually struggling with, Cordate is active with investments since 20 years. And recently we've decided to start fundraising. And our aim is actually to invest for the poor, to support job creation in the most fragile and conflict-affected areas. But the struggle we have with our fundraising is that a lot of people have these benchmark, these market expectations. And the blended model, even though it's generally acknowledged that it is necessary and that you cannot function without it, very few investors are actually prepared to have slightly less return because we are active in more difficult contexts that are more expensive to manage. So I was wondering actually if you have a solution for that. How can we stimulate that understanding that higher risk is not necessarily higher return, but in our case actually lower return because higher costs of functioning?
I think there's room for a lot of education in the space that you bring up, Laura. But I think most investment committees are looking at their fiduciary responsibility about how they handle the funds that they're looking at and how they're managed. And so if you're looking for a concessional rate of return, many of our organizations will put that into a different part of the organization, right? It's probably going to go into the mission area. So having that conversation with the investment committee is not always easy because it's not within their frame of reference. That's my experience.
The question is, what is a concessionary rate? Because if you expect the market return to double digits and you come with a single digit, which is actually above 5%, for me, it's not a concessionary rate. So the whole question of the benchmark.
Yeah, but I mean, our expectation is not double digit across all asset classes, right? So yes, there are some where that's the case, but it's not across all asset classes that somebody's expecting double digit return.
Yeah.
I would say that 5% return, depending on the nature of the investment, is definitely a concessionary rate of return for the risk profile that you're talking about in some of these situations. So I agree it depends greatly on the type of product. If it's credit, that might be a different story depending on the country and so forth. But it really raises a question in my mind, Laura, when we say market returns versus concessionary returns, when you really adjust for risk, how many of these initiatives don't have at least a little bit of concessionary return baked into them, because the reality is the risk in many of these countries of investing equity in some of these initiatives is really very high. So I don't know if anybody has a comment on that or a thought on that, but
Well, I think it states the obvious that the poor are already at a disadvantage. For them to do a startup and to find someone that's going to have interest in them and to support them, they don't have the history, they don't have the structure. And I'm not sure how that gets developed so that they can fully participate in this new world of impact investing.
so we're getting the high sign to stop. It's not the first time we've seen it either, so we better stop. So anyway, please give a round of applause to our panelists. Thank you.